You might wonder why a single economic number released in Washington, D.C. can immediately move markets halfway across the world. When that one specific announcement goes live, it ripples out to hit global stocks, bonds, gold, and local markets like Vietnam's VN Index, all at the exact same time. To understand why, we have to look closely at what inflation actually is. We usually think of it as prices going up, but it is more accurate to think of it as your money shrinking. It is the steady loss of your currency's purchasing power. Think of it like a trip to the cafe. Last year, 100,000 dong bought 2 coffees and a sandwich. This year, that same 100,000 dong only gets you the 2 coffees. The money itself lost its strength. Because inflation silently eats away at the power of money, central banks have to step in and take action to protect it. And their response is the first domino in that global chain reaction. Governments track this loss of purchasing power using something called the Consumer Price Index, or CPI. Picture a standard shopping cart filled with a fixed list of everyday items, things like groceries, gasoline, and rent. The government checks the price of this exact same cart every single month. This is a helpful way to measure the immediate day-to-day price changes consumers feel at the checkout counter. But this rigid cart has a flaw. It includes items whose prices jump around wildly. That is where economists use a second measure, called Core CPI. To find it, they reach into that shopping cart and physically pull out food and energy. They remove food and gas because a bad storm can ruin a crop, or global politics can suddenly spike oil prices. Those events cause temporary shocks that can hide what the broader economy is actually doing. By stripping away those volatile items, Core CPI gives us a much clearer look at the baseline. It tells us if higher costs are just a passing phase or if they are becoming a permanent, sticky problem in the structural economy. In the United States, the central bank is the Federal Reserve, and they prefer to use a slightly different measuring tool called the Personal Consumption Expenditures Index, or PCE. If CPI is a rigid basket, think of PCE as a smart cart. It recognizes that humans adapt. If the price of beef doubles, rigid CPI assumes you pay double, but the smart cart notices you actually buy cheaper chicken instead, lowering your grocery bill. It actively adjusts to reflect changing consumer habits in real time. It also has a wider lens. PCE includes costs paid on your behalf by someone else, like an employer paying for your health insurance. The standard CPI ignores those entirely. Recognizing this broader view, former Chairman Alan Greenspan shifted the Federal Reserve's focus away from CPI and over to PCE in the year 2000. This line graph compares the CPI and PCE price indexes from 1970 to 2017. Because CPI doesn't account for substituting cheaper goods, it consistently measures inflation higher. Over the decades, you can see the two lines drift further apart, creating a widening gap. If the economy is a patient, PCE is the full-body scan. It gives the central bank the clearest possible picture so they can decide exactly what economic medicine to prescribe. When the data shows that inflation is running too high, the Federal Reserve's primary medicine is to raise interest rates. They make money more expensive to borrow, which cools down spending. But raising those interest rates does something else entirely. It turns the United States into a massive financial magnet. Investors naturally want the highest return on their cash, so when U.S. interest rates go up, global investors rush to buy American assets, which drives up demand and strengthens the value of the U.S. dollar. This is where we see the dominoes start to fall. To buy those high-yielding American assets, investors cull their capital out of emerging markets. Money flows out of riskier investments and pools heavily into the safe harbor of the U.S. dollar, and that directly impacts local economies. In Vietnam, for example, as foreign capital exits, local stock prices drop, exchange rates face pressure, and the VN Index takes a heavy hit. However, the reverse is also true. If the PCE data shows inflation cooling down, the Fed will cut interest rates. The dollar weakens, and that same capital floods back out into global markets, boosting local stocks and pushing up the price of safe havens like gold. To see these shifts coming, watch 3 specific numbers. First, the U.S. Core PCE. Second, the 10-year Treasury Yield, which is the global baseline for what safe money earns. And finally, the U.S. Dollar Index, or DXY, which acts as a scoreboard comparing the dollar to other major currencies. These indicators help you predict the Federal Reserve's next move. When you understand whether borrowing is about to get cheaper or more expensive, you can see exactly where global capital is going to move next. Stay sharp, keep learning, and see you in the next episode of LIEMPT Core Investing.